This is Taking Stock on Bloomberg. I'm Pim Fox. Now, how have financial stocks run their course? Well, let's find out about that and the general market. Joe McAlinden of Catalpa Capital, he was positive on the financial sector back in July, not as positive as he was back in March. The market has come a long way since then. So what does he think now? Joe, it's good to have you with us. Thanks for coming in.
Thank you, Pim.
You know, in fact, thinking about having you on, as I mentioned, when you were here in March, I think it was the second week in March we were just talking, you were saying that we were going to enter a bull market and that we were going to get a V-shaped recovery. And lo and behold, this is what's happened.
Well, the basic idea then, and still is, that we were all very focused on the U.S. housing crisis and the credit crunch. But my argument was that there were three different things that came together to form a perfect storm. There was that, the housing crisis and the credit crunch, the Beijing Olympics and the global inventory cycle that produced, and thirdly, the foreign central banks, the ECB, the Bank of China, Australia, all had been tightening monetary policy right up into the storm, right up into the eye of the storm until October, November.
So like it took a crisis in order to get them to change their minds.
Right, and they all changed their minds. As I said then, it's kind of like fans at a Jimmy Buffett concert when he says fins left, fins right. They all go like that. And they all went to massive easing. The Beijing Olympics phenomenon has passed. China went into a big inventory restocking cycle, and they had a massive stimulus program, which was, frankly, far more effective than ours. And our housing crisis is slowly coming to an end. We're seeing more and more data. There's some numbers this morning indicating that home prices are beginning to improve.
All right, but when you take a look at a chart of the S&P 500, it already gives you that V. Are we done with the V, or is it going to continue to go up?
Well, we've had a V, but remember that the market at the top of the last bull market on the S&P was over 1,500. So, yes, we're back to 1,000, but we've got a long way to go before we make any significant new highs. So I think in this first move, this first leg of the new bull market, we're going to move up to 1150, 1200 before we have a very significant correction. We will at some point have one.
So another 150 points to go on the S&P 500?
I think so, over the next 6 months.
What gives you the confidence? I mean, when you take a look at things like personal spending, we were talking with Scott Minard of Guggenheim Partners and Dan Greenhouse of Miller Tabak. We were talking about the items of whether it's personal spending, personal savings, inventory builds. Is this just a math equation where it just isn't getting any worse, so that means it gets better?
No, but I'm guilty myself often of a U.S.-centric view, because I was born here, I live here, most things in my life go on here. But there's more to the world. We're 310 million people out of 7 billion. And housing prices in the U.K. have been turning around very sharply. China's in a very strong recovery at the moment. We hope it continues. And there are signs that Europe's turning up. All that contributes to a global economic rebound, which will have a feedback effect on the U.S. Right now, there's a lot of confusion in terms of sentiment for folks in the U.S. We've been bogged down in this healthcare debate. Sentiment has slipped a little bit. And I think as the global economy continues to rebound, you're going to see consumer spending pick up in the U.S. as well.
All right, what about people spending on stocks? I mean, if you missed the rally, if they didn't hear you in the beginning of March, or indeed they were gun-shy for whatever reason, is there time to get in? I mean, should you go in and try to capture this last 150 points on the S&P, or are there better ways to make some money in the market now?
Well, I think there's sector emphasis, which we can get into a little bit. But yes, I think that look, we went through a very extraordinary phenomenon, and we did make a V kind of bottom in stocks. And I don't think you're going to see levels like we saw in March again.
No 666.
I do not see that in our lifetime.
Okay, all right. We're going to continue the conversation. We've got more with Joe McAlinden of Catalpa Capital. We're going to talk about specific sectors to profit from in the stock market. Back in March, you remember back in March, 666, S&P 500 back in March? Yes, Joe McAlinden, he was telling us the economy would start to recover this year. Well, it has, at least as far as the stock market is concerned. And can't argue with the actual numbers. Joe, so what do you do if you want to allocate new money right now? Do you start putting it into the stock market, grab those extra 150 points as you talk about on the S&P 500?
Yeah, well, yes. If you're talking about long-term investment funds that are in the market for the next 5 or 10 years, you should have an asset allocation, and you're an individual investor. You should have an asset allocation program and you should be following that asset allocation program. And whatever the program says your percentage allocation to stock should be, you ought to be there. And if you're below that, you should be getting fully invested for that portion.
And you might be below it just because the market has actually declined so much.
You might, and it might be worse than that. You might have sold some stocks at the bottom, which is what a lot of people did, and moved into bonds. And they're behind the 8 ball on that, and that's going to be hard to make up. But I think over the next 5 to 10 years, we are not going to see this kind of bloodbath that we went through down to those levels again. And the trend is going to resume. The long-term upward trend in equity prices is going to resume, and total returns are going to be very rewarding. And so I think people who are long-term investors should be in this market, and even short-term guys. Now I'm kind of, like Grandma saying, do as I say, not as I do. Because
well, you're in the business,
we're in the business,
you're trading and you're taking short-term as well as long-term bets.
Yeah, and we've been long, as you might guess, net long the market, and we're staying net long the market. We think that through the end of the year, maybe into next year, we're going to have a continued upward move without a major pullback. And by the way, people forget that coming off the market bottom after the tech bubble, and the final bottom was in March of '03. The market went up for over a year without as much as a 10% decline. And even the terrible seasonals that we're about to go into in September, October didn't disrupt that trend.
So what do you think in terms of allocating to the stock market? I mean, you mentioned China. You mentioned the fact that there's more to the world than just the United States. Should people who really want to capture this upside, should they be looking overseas?
Well, a good diversified portfolio should be a global portfolio these days. You do get a lot of global exposure just through the S&P 500, but it makes sense to have some money in IFA, or the index, if you were an index fund buyer, and maybe a little bit in emerging markets, because that's where the rapidly rising living standards and rapidly rising GDP are going to be happening in China and Greater China and South Asia.
And what about ETFs, for example? Should you be going into these turbocharged ETFs to try to take advantage of the fact that maybe you missed part of the V that Joe McAlinden called in March? You want to make up for it.
There's some hilarious commercials that have been running on TV lately, and I think I saw one while I was waiting to come on, about reading the importance of reading the fine print, of playing around with a kid, giving him a truck, and then giving him a paper truck. And people need to read the fine print on these things. Some of the turbocharged ETF instruments are not for the average person. But the basic ETFs that give you, like the SPDR, that gives you exposure to the U.S. stock market or to non-U.S. stock markets, so you can get sector ETFs. There are some sectors that we like better than others. And,
which ones do you like better than others right now?
For example, I still like financials, IT. And, picking up on what we said about the U.S. consumer, I think consumer discretionary, both housing-related and general retail, are going to be very strong. And industrial materials, because of the global nature of the boom and what you're seeing in commodity prices. And we'd be underweight telcos and utilities and healthcare and
underweight
staples.
Really the defensive sectors, the traditionally defensive sectors of the market.
Right. And you can find ETFs that give you direct exposure to all of those sectors as an individual investor. You can even find ETFs that give you exposure to sectors of the market in the emerging markets. So there's just hundreds of these things that have been created.
What's the riskiest bet you're taking right now?
Well, there's a way you can bet on the recovery in housing with a leveraged.
All right, no,
again,
that's okay.
Grandma's wisdom.
I understand. No, you're a pro. Don't try this at home.
Don't try this at home. But there is
leveraged ETF in the housing market
on housing prices, and you can bet either way, whatever your bet might be. If you think they're going to go up, there's one ETF. If you think they're going to go down, there's a different one. That stuff is very, very dangerous and not for the average investor.
Don't do this at home. This is something only for the professionals.
Right.
All right. I want to thank you, professional Joe McAlinden, coming in from Catalpa Capital, giving us an update on that V-shaped recovery and also the V-shape of the stock market. Thank you very much. Appreciate it.